China and India, home to nearly 3 billion people, have just slammed McDonald's with a crippling 300% tariff on all imported goods. Now, this isn't just another trade dispute, it's a targeted shot at a global icon, pushing its entire Asian operation to the brink. The Golden Arches, a worldwide symbol of American business, are now facing an extinction-level event in their two most critical markets. The question isn't about profit anymore, it's about pure survival. Can McDonald's find a way to navigate this unprecedented crisis? Or are we about to watch the single greatest corporate meltdown in modern history? Section 1. The stakes. To really get the scale of this disaster, you have to understand what a 300% tariff actually means. It means the cost of every single thing McDonald's imports to build its restaurants and serve its food has just quadrupled. Overnight, we're talking about everything from specialized kitchen equipment to those key ingredients that make a Big Mac in Mumbai taste just like one in Montana. This is a business that serves over 1.3 billion customers a year in China alone, with plans for 10,000 restaurants there by 2028. In India, its franchisee operates a massive network of over 390 restaurants serving 200 million people a year. Together, these markets represent the entire future of McDonald's global growth. Now, let's be clear, this specific 300% tariff is a hypothetical scenario, but it's designed to explore a very real threat facing every multinational company today: getting caught in the crossfire of geopolitics. Rising nationalism and the decoupling of global economies aren't just buzzwords anymore. They are active threats that can flip a business model on its head without warning. This isn't just a what if, it's a stress test of a global titan against the harsh new rules of the world economy. Section 2. The immediate fallout. The initial shock would be catastrophic. The first casualty? The supply chain. McDonald's built its empire on a three-legged stool philosophy: the corporation, its franchisees, and its suppliers, all working together. This system depends on a complex global network to keep things consistent and efficient. A 300% tariff doesn't just disrupt this network, it shatters it. Key ingredients and special equipment, once easy to get, suddenly become financial poison pills. The cost of doing business doesn't just go up, it becomes a vertical wall. Profit margins, which are already feeling the squeeze from inflation and competition, would just evaporate. For a company that's built its brand on value, that's a fatal blow. But the damage goes way beyond the balance sheet. A tariff like this is a political statement. It's part of a bigger trend in both China and India toward economic self-reliance. Campaigns like Vocal for Local in India already make things tricky for Western brands. A move this aggressive makes that sentiment official policy. It transforms McDonald's from a beloved fast food joint into a symbol of foreign influence, making it an easy target for boycotts and public anger. Section 3. The why, a new world of economic warfare. So, why would China and India make such a crazy move? In our scenario, this isn't random. It's the explosive result of years of simmering geopolitical tension. The world has been drifting away from pure globalization and towards strategic competition. A trade war is no longer just about steel or microchips, it's expanded to include cultural symbols. In this new Cold War-style game, a brand like McDonald's isn't just a restaurant, it's seen as an arm of American soft power. Targeting McDonald's accomplishes a few things. First, it sends a crystal-clear message to the United States: your corporations are vulnerable. Second, it plays perfectly with domestic policies trying to boost local businesses. It's a headline-grabbing move that fires up nationalist feelings and asserts economic power. In this tense new world, being globally integrated doesn't protect you, it exposes you. A 300% tariff on McDonald's would be the corporate version of a military blockade, designed to cripple, isolate, and force a retreat. Section 4. The War Room, McDonald's Playbook. Picture the emergency board meeting at McDonald's HQ. The company's future is literally on the line. There are no good options here, just a menu of painful choices. Let's break down the playbook. Option 1. Eat the cost. The first instinct might be to just absorb the tariff. Keep prices stable, keep the customers happy, right? But the math is brutal. A 300% hike would instantly vaporize profits. McDonald's is a business of high volume and thin margins, not a luxury brand. Trying to eat this cost would mean running thousands of restaurants at a staggering loss. That's not a strategy. It's a speed run to bankruptcy for their Asian operations. So that door is shut. Option 2, pass the cost to consumers. Okay, so what if they just raise prices? A Big Mac that costs 3 or 4 times what it did yesterday. This is also a dead end. Fast food customers, especially in the value-focused markets of China and India, are incredibly price-sensitive. People are already dealing with inflation and have plenty of local options. Tripling the price of a burger would be commercial suicide. Restaurants would be empty in a week. Competitors would swarm in to pick up the pieces. That door is also shut. Option 3, go 100% local. This is the most complicated but most talked about option. On paper, it works. If the tariff is on imports, just get everything locally. And to be fair, McDonald's has already made huge progress here. In China, over 90% of its ingredients are already from inside the country. India's menu is heavily localized, with items like the makalu tikki, and depends on local supply chains. But mostly local is a universe away from 100% local. That last 10% often includes specialized kitchen machinery, secret spice blends, or specific types of potatoes that are vital for the brand's global consistency. Building a totally new, 100% local supply chain for every last part is a logistical nightmare. It would take years of investment and could mean compromising on the very thing that makes McDonald's, well, McDonald's. It's a possible long-term fix, but in the short term, it's a chaotic scramble that would see quality and consistency nosedive. Option 4, pull out completely. This is the nuclear option. Just cut their losses, abandon the 10,000 plus restaurants, and leave Asia behind. The immediate financial hit would be staggering, billions in investments written off. But the long-term strategic loss would be even worse. China is McDonald's fastest growing market. These aren't just any markets, they are the company's future. Pulling out means surrendering the world's biggest consumer economies to your rivals. It's admitting defeat so loudly it would echo for decades. This is the one option the board would do anything to avoid. Every option looks like a path to either ruin or a complete, painful reinvention. Before we give our final verdict on what they'd likely do, what do you think? Is there a 5th option we're missing? Let us know your strategy in the comments. Section 5, the final verdict. So, can McDonald's survive? Yes, but it wouldn't be the McDonald's we know. There's no magic bullet. The only realistic path forward would be a painful, desperate combination of almost everything we've discussed. First, they'd have to enter intense, high-stakes negotiations with the Chinese and Indian governments, while probably starting a strategic retreat. They'd close weaker stores and freeze all expansion to stop the bleeding. At the same time, they'd launch a crash program for radical localization. That last 10% of imported goods would become the company's only mission. They'd pour emergency cash into finding or creating local replacements, even if it means the fries taste a little different or the ice cream machine comes from a new domestic supplier. The world-famous McDonald's consistency would have to be sacrificed to survive. The menu would shrink, focusing only on items that can be made 100% locally. The company that crawls out of this crisis would be a shadow of its former self in Asia. It would be smaller, less profitable, and fundamentally different. Its global brand, built on being the same everywhere, would be fractured. It would survive, but as a cautionary tale. Conclusion: this 300% tariff scenario, while hypothetical, points to a terrifyingly real shift in our world. The era of easy globalization, where a brand could take over the planet with one consistent product, is over. Geopolitical risk isn't just a boring line in an annual report anymore, it's a core business reality that can bring a giant to its knees. This shows how a company's greatest strength, its global reach and iconic brand, can be twisted into its greatest weakness. For McDonald's and for every multinational company out there, the message is clear. In the 21st century, the front lines of global conflict aren't on a battlefield, they're on your balance sheet. And survival now depends on navigating a world that is actively pulling itself apart.